Last quarter of 2025, and how will Keppel DC REIT fare for 2025? I declare I'm a shareholder, and I'll also share my take on the rights that we need to participate. You can use the timestamps found in the video description below to jump to the portions that are relevant to you. So I am biased, practice independent thinking. How will Keppel DC REIT fare for 2025? To know that, I'll use my framework to guide myself and increase my confidence. You can adopt a best practice so that you develop a framework to build your own confidence. First step in the framework, did the points mentioned in the earlier quarter materialize in this last quarter? We're comparing Q1 and Q2. My last Keppel DC REIT video mentioned these points regarding the future of Keppel DC REIT. Finance income from Australian note provides Australian dollar 6.3 million a year with yearly rate escalation. This activity completed on 25th June 2024. Its book accounting completed on 25th June 2025. The first Japan DC acquisition completed on 31st July 2024, and its book accounting completed on 31st July 2025. Next, SGP7, SGP8 acquisition completed on 27 December 2024. It has reached halfway of its book accounting journey. Wait, you might be thinking, why do I need to track all these things? Simple, I want to track the contributions of all these business events as it influences the distributable income that ends up influencing my DPU per unit. There was also the MLA renewals. MLA in law means Master Lease Agreement. So these renewals happen at SGP1 and SGP2, and this slide sums up the progress of these business updates. 1. Higher finance income, checked. Tokyo contribution, checked. SGP7 and SGP8, checked. Master lease renewal at SGP1 and SGP2, checked. I also placed the 5 quarters side by side to observe for the presence of quarterly growth. So here's the table. In a nutshell, gross revenue and net property income increased quarter by quarter due to the contributions of acquisitions and MLA renewals. And the red color means a dip in that quarter when I compare it to the previous quarter. Finance cost is also shrinking because acquisitions were funded by equity, and the results is increasing distributable income and distributions per unit. But let's pause here to review the results of the matrix. Gross revenue, net property income, distributable income, distribution per units are increasing. Finance cost is shrinking. All sounds good. But before we get carried away, I want to repeat the cycle one more time with this framework. Question: what other factors can allow Keppel DC REIT to increase its revenue further? So recently I upgraded the framework so that it's obvious to me, because every time when I look at a REIT, I use this framework time and time again. The upgrade is, if it's a data center REIT, is the tenant the sole occupier that contributes to tenant concentration risk? And if going all into Keppel DC REIT is your intention, please take note that the top 10 tenants contribute 82.2% of rental income. That's a tenant concentration risk. Upcoming, there are going to be data centers with even shorter WALEs. Look at the whole portfolio. Cardiff Data Center is left with 1 year WALE as at 30th June 2025. Cardiff Data Center contributed 5.4 million in revenue in FY 2024 of 302 million. That's a 1.7% of revenue. Gore Hill Data Center is left with 1.2 years WALE, 2 tenants as at 30th June 2025 that contributed 13.5 million in FY 2024 of 302 million. That's 4.5% of revenue. GV7 Data Center is left with 1.6 WALE, as at 30th June 2025. That contributes 5 million in FY 2024 of 302 million. That's 1.6 of revenue. Though they aren't big movers, but if you combine them, that's a revenue contribution of 7.8%. That's significant enough to check in with your managers on their future whenever I'm getting that opportunity. Next, let's welcome the new Japan kid into our blog. Are you supporting this new Japan DC acquisition? For all the key investment metrics, no doubt about it. That's why our REIT manager would propose this acquisition. More interestingly would be the DPU increment, which we see here as 2.8%. But I want to take note of what is the cost of this acquisition. It is around 708.3 million, of which two things will happen: debt and equity. The debt will fund 473.6 million, but will finance costs increase? The other portion, which is 229.8 million, is going to be funded by equity. There's also going to be 4.9 million in acquisition fees in units. But will more shares reduce the DPU? So that comes to the golden question: subscribe or not to subscribe? The preferential offering doesn't only address the new acquisition, but other items too. What is least expected in that list is the AEI for Keppel DC SGP8, because the EFR earlier on should have addressed it. There's also the 30 years land extension for SGP1, okay, that makes sense, plus the debt repayment of 104.5 million. These three initiatives will increase the DPU accretion by another 0.6%. Okay, we went through all this stuff. What should we make out of it, right? Simple, it is the potential DPU by the end of 2026. It's not a guarantee, but in my own framework, it guides my purchase. Forecast the future, buy the present. So, from this, I did some sums, and we get this table. And note that this table accounts only the new DC acquisition. It doesn't include the other DPU accretion of other initiatives like the AEI, land extension, and the debt repayment. My assumptions are second half 2025 having the same results as first half 2025. And we add the delta. The delta is taken from the earlier table in the acquisition document, and we arrive at a potential DPU of 10.211. If I subscribe the offering at 2.24, that's a 4.5% return, which now you and I need to consider. One disclaimer though, unlike other REITs which would share its property yield, Keppel DC REIT didn't share this aspect. From DPU perspective, it is accretive. From a capital allocation perspective, is it accretive?